All right, 30 minutes until the start of the cash trade. We are looking at futures in the red. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the state of the consumer. Retail sales barely rise in April, another sign of a pullback in spending. And placing their bets, Jamie Dimon says he wouldn't take a recession off the table, while Steve Cohen says he sees a 45% chance of a recession. And another deal in sight, oil drops as President Trump says the U.S. and Iran are inching closer to a nuclear agreement. Katie, what are you watching?
Well, it's still earnings season, so we have two movers on the earnings front. Walmart reported solid sales and earnings growth, but cautioned that tariffs and economic turbulence will eventually lead to price increases. You can see down a little bit pre-market. And then we have Deere lowering the bottom of its profit outlook range as tariff uncertainty weighs on demand, but currently up about 2% pre-market, Matt.
Yeah, interesting to see that Deere move. We're also watching an M&A deal. Dick's Sporting Goods will buy Footlocker in a $2.4 billion bailout. That's an 86% premium to yesterday's closing price. Katie?
And just a few minutes ago, Jerome Powell said that the Federal Reserve is weighing changes to key parts of the framework that guides its monetary policy decisions.
In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting.
Joining us now is Bloomberg's international economics and policy correspondent, Michael McKee. And Mike, when you say the Fed's going to change its framework, I think a lot of people pay very close attention. What exactly is going on?
Yeah, it doesn't have any bearing on the current economy or monetary policy, but back in 2020, they adopted their new framework, which said because inflation had been so low and because the economy was growing strongly, we can let that continue and we can run the economy hot. And then we got the big inflation. And so there is obviously, looking back, some regret about that, and they're thinking we're going to change that. They haven't figured out exactly how they're going to frame the new framework, but that's the process that's in motion right now. But basically, you can expect them to kind of go back to where they were before. We're trying to anticipate where the economy is going.
Interesting. So laying the groundwork there to reframe the framework. I also want to get your take on the data that we got this morning, because we got retail sales, we got PPI, we also got some manufacturing surveys as well. What stuck out to you?
Producer prices stuck out to me, and retail sales, because they both told a story of tariffs finally starting to hit the economy. Retail sales headline was up only 0.1%, but that was largely because we bought fewer cars, and we've discussed that, the pull forward there. But the control group, that is all the stuff you buy on a regular basis, goes directly into GDP, was down 0.2% during the month, and that was a surprise. The PPI falls by 0.5% on the headline, and the core ex-trade falls by 0.1% and goes from 3.45% on a year-over-year basis to 2.9%. That's a big drop. And what happens there is the trade part is wholesale and retail margins. And so it looks like companies were absorbing some of the tariff increases into their margins.
Well, that leads nicely to our discussion on Walmart. That is Bloomberg's Mike McKee, our international economics and policy correspondent. And let's get back to Walmart now, because it reported strong results, but you had the CEO warning basically that there are price increases to come. Joining us now at the desk is Bloomberg's Shelly Banjo. So, of course, it was a pretty solid quarter, but everyone is focused on the look ahead, and the look ahead seems to be that the dollar signs are going up.
Yeah, it was a real tone shift for Walmart, which came out in April saying we're absorbing the price increases. We're a big company. We can absorb all these things. And we think that we're going to be able to actually gain out of this by market share. Then you have them come on today and say, there's only so much we can absorb. There is actually a limit, and that they are going to already start seeing price increases starting pretty soon, and they expect to be able to raise prices, in the coming months.
We also had a deal, Dick's Sporting Goods taking out Footlocker for a massive premium, right, to yesterday's closing share price. Are we going to start to see, you think, a lot more deals like this?
This is the second consumer-related deal that I think was tinged with tariffs. So the first one was Skechers going private, saying, you know what, we will better be able to manage our business out of the public spotlight. And so now you have Dick's buying Footlocker. Footlocker was struggling. They were both hit by tariffs, saying, we're stronger together than apart right now.
All right, Shelly, thanks very much. Shelly Banjo there talking to us about the consumer stories tied to the market. Here to break it all down is Charles Grom, Gordon Haskett, senior retail analyst. He has a buy rating on Walmart with a $105 price target and a buy rating on Dick's with a $250 price target. Let's kick it off, I think, with Walmart because that is, good morning, Chuck, the big story for markets, really for the economy. What do you make of the earnings?
I think, looking back, the first quarter was very healthy for Walmart. And we think, frankly, for most of retail, the cadence throughout the quarter got better as we progressed, pretty much known by the market at this point, with April being good. You had Easter shift, weather getting better. Overall profitability for Walmart was actually very good. Inventory's clean. So I think looking back, the first quarter was very good for Walmart.
It's interesting, Chuck, if you take a look at the details here, even though they did beat when it comes to several metrics, they had sales rise 4.5%. If you look at the details, you did have transaction growth slow. You also had grocery and pharmacy really holding up, whereas general merchandise seemed to slow here. Looking at those details, you could say this looks pretty worrisome when you think about the health of the consumer.
Yeah, I would say if there is any blemish in the comp, to your point, it's a great point, that traffic on a 2-year basis did slow. If you sort of unpack the 4.5% comp and strip out e-com and strip out the benefits from GLP-1, you're looking at basically a flat comp. But general merchandise has been choppy for Walmart for quite some time. It did improve overall. Deflation did weigh on the category, and there was mixed results. I mean, apparel and toys did better. CE Home did worse. We'll hear from other retailers in the coming weeks, but our sense is that Walmart's number, that 4.5%, will be a bright spot when it's all said and done.
I want to ask about the deal, $2.4 billion, 86% premium for Footlocker. Yeah. Is this, are we going to start seeing a lot more deals like this as tariffs force these retailers to consider their options?
It's possible. Looking back historically, retail deals like this tend not to be that great. I mean, the one that comes to mind for me was when Dollar Tree purchased Family Dollar a decade ago. And as you know now, Dollar Tree is unwinding Family Dollar. So this deal, I think, comes as a little bit of a surprise. We're going to hop on the Dick's call as soon as I get off here to learn more about their strategy. But for a really solid company in Dick's Sporting Goods to buy really a mall-based retailer with a lot of international exposure, I think, is a bit perplexing, and that's why Dick's stock is down about 10% pre-market right now.
Well, that's where I wanted to go, Chuck. And like you said, you're about to get on the call to find out a little bit more about the strategy. But one of your peers over at TD Cowen said that before the deal was formally announced that this would be a strategic mistake for Dick's. Basically, it'll leave them more exposed to streetwear and lifestyle fashion. They're also going to be competing with more nimble sneaker retailers. It sounds like you share some of those concerns.
Yeah, we do at this point, but we'll see what they say between 9 and 10 and go from there. But, Dick's, they were actually reported today, which is another sign of a healthy first quarter for the consumer, over a 4% comp, whereas Footlocker reported a low single-digit decline. And I think that's sort of, the concerns here is that Dick's has been executing near flawlessly. They're one of the few retailers that during COVID gained a lot of customers and actually have done a phenomenal job holding on to that customer base. So many companies we cover, whether it be Wayfair or Target, have really receded and given all those customers back. So this deal is definitely perplexing at this point in time.
And Chuck, broadening out, looking at your entire coverage universe, you have a lot more reporting companies in the weeks to come. You think about Costco, for example. We have BJ's slated, as well as Target. When you think about Walmart's results this morning and those sort of worrisome details in that, the warnings about price increases, what can you extrapolate out to the rest of your coverage universe?
Yeah, that's a great question. I think EDLP is going to win today. It's going to win in the second quarter. It's going to win in the back half of the year. And I think companies like Costco and BJ's that have that lower price are going to win. Companies like Target on a basket basis are 10% higher than Walmart in our studies. That's concerning. The dollar stores are higher than Walmart. That's concerning. So I would lean favorable on companies that have those low prices, and by the way, a lower SKU count. I mean, one of the reasons Costco is so successful is they only sell about 3,800 SKUs. So if they see a price go higher in an item, they don't necessarily need to sell it, whereas most retailers do. So we're very bullish on both the warehouse clubs and, frankly, you know, the Sam's Club numbers within Costco today, over a 6.5% comp, were very good.
All right, Chuck, we're going to let you go get to that Dick's call. Really appreciate your time this morning. That is Chuck Grom of Gordon Haskett. Meanwhile, a quick check on futures right now. You have a move lower on the S&P 500. This would snap 3 straight days of gains. The S&P 500 off by about 0.3%, putting that fragile year-to-date gain in jeopardy. The Nasdaq 100 also a little bit lower. The small caps relatively unchanged right now, but the color is red. Meanwhile, Matt Miller, we do have some more movers on our radar. Cisco boosting its full-year revenue guidance. You can see the stock being boosted as well. And then CoreWeave, a recent IPO.
Yeah, absolutely. CoreWeave has been killing it up 60%, more than 60% since it went public. That was at the end of March. And you can see United Health down another 8%. This is a company that has seen its market cap cut in half this year, appointed a new CEO this week, pulled its guidance, and now we're learning that it's being probed by the Department of Justice over Medicare fraud. That, according to the Wall Street Journal, the company has said it has not heard from the Department of Justice and that it abides by all the rules.
Yeah, looking forward to more details there. But what a week to forget for United Health, and down another 8% pre-market. It'll be interesting to see how it settles up. Now, coming up, we're going to head to the Middle East, where President Trump is pushing for deals with Iran and India. And before we go to break, Bloomberg asked Jamie Dimon about his economic outlook. Here's what he had to say.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
Let's get now to high interest, a look at what's making headlines around the world. A looming New Jersey Transit rail strike could upend the commutes of over 350,000 people a day starting tomorrow as engineers prepare for the first walkout in over 40 years. The engineers are seeking parity in pay with engineers at other commuter railroads in the area, like the Long Island Railroad. Meanwhile, New Jersey Transit officials maintain that they cannot afford to pay the increases the union is demanding. The agency is urging people to start working from home. And 2 New York Republicans, Nicole Malliotakis and Nick LaLota, are signaling that the cap on the state and local tax deduction may rise to as much as $80,000. The current $10,000 SALT cap expires at the end of the year, and lawmakers from high-tax states are demanding a boost in exchange for their votes on President Trump's tax package. Their support is critical. House Speaker Mike Johnson needs the support of nearly all Republicans in order to push the bill through the chamber. President Trump is suggesting the U.S. is closer to an agreement to curb Iran's nuclear activities. He spoke at a business event yesterday in Qatar.
Iran has sort of agreed to the terms. They're not going to make, I call it in a friendly way, nuclear dust. We're not going to be making any nuclear dust in Iran. And we've been strong. I want them to succeed. I want them to end up being a great country. So we'll see what happens. But we're in very serious negotiations with Iran.
The news of the potential agreement, meanwhile, is prompting a sell-off in oil. As you can see here, we're looking at a drop of 3% over the past couple of days. Joining us now from Abu Dhabi is Annmarie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. She is following President Trump on his Middle East trip. And Annmarie, what has exactly happened here? What has the president heard that makes him think we're closer to a deal with Iran?
Well, when the president was talking about this in Doha before he touched down right here in Abu Dhabi, he was saying, you might have seen the report. There was a report of a top advisor to the Ayatollah of Tehran saying they're ready to make an agreement with the United States. But, Matt, they listed what that agreement for them would mean. They're willing to not have nuclear weapons, but they still want to enrich uranium and have a civil program. Basically, if you read that report, what they're outlining is the exact deal that Trump and his first administration pulled the United States out of, the JCPOA. Trump went on to say when he was talking about Iran, because he, of course, was in Doha saying how the emir wants him to really do a diplomatic deal. And Trump was talking about we could do this the intelligent way, a deal, or we could do this the brutal way. There, of course, is going to be a menu of options for this administration on how they want to deal with Iran and thwarting their nuclear capabilities. We should note that earlier in the week, Trump also talked about other grievances he has with Iran, not just enrichment of uranium, but also the fact that they financially, politically support the terrorist organizations in the region and the proxies when it comes to Lebanese Hezbollah, Hamas, and Houthis. So Trump once again put out an olive branch, but we should make clear what the Iranians were talking about in that NBC report is exactly the deal that Trump pulled out of when he was president as the 45th president.
And you're looking at live shots of President Donald Trump in Abu Dhabi right now. Annmarie, I want to talk a little bit about Apple because we got some interesting headlines from the president, some interesting sound bites saying that he talked to Tim Cook and basically asked them to stop building plants in India. He wants to see that production come back to the United States.
That's right. Second time this trip that the president has called out Tim Cook. The first time was on Tuesday in Riyadh. The president was looking out to the audience of investors and business executives and say, I see my friend there, Jensen Huang of NVIDIA. Tim Cook's not here, but you're here. And then in Doha, he was talking about India and the fact that India says they are ready to bring their tariff levels for zero, potentially lining up another trade agreement in principle with India. And then he said he just got off the phone yesterday with Tim Cook, and he was annoyed with Tim Cook because what we see from Apple is they're moving their production of iPhones from China to India. So Apple's looking at de-risking, moving their supply chain, but it doesn't seem to be enough for the president. He says, we don't want you doing this in India. We want you doing this in the United States.
All right, Annmarie, great reporting as always. That is Bloomberg's Annmarie Hordern reporting from Abu Dhabi. And the Apple story is really interesting to me, Matt, because for Apple, it would be so expensive to build these iPhones in the U.S. And we're talking about Apple here.
Right.
If they're having these problems and trying to ship to India, now being told that's not okay, you have to imagine there's hundreds and thousands of other countries facing the, or companies rather, facing these same problems.
On the other hand, you know, I have a 4-year-old daughter. I've been training her to work with a tiny little screwdriver.
That's great.
Because I'm hoping for that in her future.
Yeah.
All right. Great to get caught up on Trump's trip right now. Coming up, we begin the trading day with Citi's Stuart Kaiser. He is getting bullish on, wait for it,
Tell me.
small caps.
Wow.
As well as technology, hardware, and home builders. This is Bloomberg Open Interest.
Well, billionaire Steve Cohen says that the likelihood of a U.S. recession is pretty much a coin flip. The Point72 founder says there's a 45% chance of a recession right now, and that markets could drop another 10 to 15% in that case. He also said that that wouldn't be a calamity. Citigroup's head of U.S. equity trading strategy, Stuart Kaiser, joins us at the desk. And Stuart, so we heard from Stephen Cohen. We also heard from Jamie Dimon just in the past hour saying that he's not taking a recession off the table. I want to hear the Stuart Kaiser view of where we stand.
Look, honestly, I think clients are in the same camp. I think we've sort of broken into two pieces. There's a group of clients that say you're pulling back on fiscal, you've added a major uncertainty shock, and you've just increased global transaction costs, and that's the recipe for a recession. And I think some people are positioned for that. I agree it's kind of a coin flip. I think before last weekend, if I had to choose, I would have said recession more likely. After this weekend, I think what you're hoping you're going to see is that soft economic data and the survey data improve and hopefully kind of reduce those recession risks. But I agree, it's definitely not off the table, even if it's not, the most likely outcome right now.
What about earnings? We had gone from an expectation of 14% earnings growth this year, after Trump, right after Trump's election, to now 8% earnings growth this year. How much does that bounce back up now that it looks like we're going to be getting a lot more deals?
I think it probably bounces back a little bit, Matt. And I think next quarter is going to be incredibly interesting because this quarter, 2/3 of S&P companies did not update guidance. They basically took a wait-and-see approach and punted on it. I don't think investors are going to be tolerant of that in 2Q. And I think a lot of these companies are going to really need to kind of sharpen up what their view on the tariff impact on their earnings is going to be. So you may see a little bit of an improvement off of what was kind of a worst-case outlook going into 1Q, but I wouldn't expect this to get back to 14%, for instance. So you're somewhere kind of in the lower end of that range.
Matt, you said something interesting there. It looks like we're going to see more deals. And Stuart, it certainly looked like that before, and we've had a lot of false dawns there. And in your view, do you see that actually coming to fruition, that we see a more acquisitive market?
More like M&A deals?
Yeah.
That's a good question.
Yeah, I meant Trump deals.
Oh, you meant Trump deals. So
I thought you meant M&A
And I probably should have said, what I should have said is the deal, the one that we've seen thus far, was better than expected, right?
With China.
With China. And
Right.
then maybe India on the way. But yeah, maybe we see more M&A deals as well.
Well, so I think, look, the M&A trade is very much an institutional investor risk sentiment trade. Our M&A target list is up 40% in the last 4 weeks. So the market is definitely trading like you are going to get, kind of the deal calendar opening up again. But to be fair, that also happened at the beginning of the year and it got completely derailed. So, will we see more M&A deals? We've seen 1 or 2 announced in the last week on the smaller side. The market is prepping to see them, but look, we need to see them happen first. But yeah, from a pricing perspective, it is starting to get priced.
I didn't mean to imply that M&A deals would be additive to earnings this year.
Yeah.
Or that M&A deals, big M&A, is ever additive to earnings.
Well, it is clear what investors want. They want more M&A and they want more trade deals. We'll see, of course, how that evolves. Stuart, you're sticking with us through the opening bell, and here is the setup as we await that ringing. You can see the S&P 500 losing its momentum after 3 straight days of gains, currently down about 0.4% pre-market. You have big tech leading that decline after leading the way up. The Nasdaq 100 down about 0.5% right now. And the small caps, they were unchanged, but now they're down about 0.2%. We are certainly going to talk about those little guys up next. The open is coming up. This is Bloomberg.
All right, we have 25 seconds to go until the opening bell on this Thursday. This is Bloomberg Open Interest. I'm Matt Miller. We saw a slight gain at the end of the session yesterday for the S&P 500. Not quite to 5,900, but maybe we make it there today. It doesn't look like it right now. We're off 1/3% on futures. We're off 0.4% on Nasdaq futures. Small caps are down as well after we got news from retailers that maybe bodes better for the market than those numbers show. American Tower ringing the bell down at the New York Stock Exchange. If you have held this stock for the past 5 years, you're up 1.97%. So at least you're not down, right? At the Nasdaq, we've got eToro ringing the bell in a celebration of their decision to go public. And they brought a lot of people. All seem very happy about that. In terms of the stocks to watch, let's get over to Katie Greifeld. She's got to look at some of the big movers today.
Yeah, it's all about earnings today, and we start with Walmart, of course, now down about 3%. That's after it reported solid sales and earnings growth in the quarter just passed. But the focus is on that caution that tariffs and economic turbulence will eventually lead to price increases, perhaps starting this month, according to the CFO. Apparently, traders don't like that. But Deere actually having a positive reaction right now, up about 5%. That's after it actually lowered the bottom of its profit outlook range due to, you've heard this before, tariff uncertainty potentially weighing on demand. But still, traders finding something to like in those shares, Matt.
Yeah, absolutely. So a couple of the big economic bellwethers, and we've got another deal in the shoe section. Dick's Sporting Goods will buy Footlocker in a $2.4 billion deal. It's a massive premium to yesterday's close, 86%. You can see Footlocker trading up to just about that, but Dick's getting absolutely decimated and then some, off 12% in the early trade. For more on the retail sector, joining us here at the desk again is Bloomberg's managing editor of global business, Shelly Banjo. And Shelly, it's really, I think, the Walmart story that economists would be paying close attention to, not the Footlocker purchase. But what does it say to you, Walmart's earnings? Is the consumer still holding up?
I think the consumer's holding up okay, but Walmart is saying that they can't absorb prices forever. So they came out just a month ago saying we're big enough, we can withstand a lot of these things with the tariffs. We want to use this as an opportunity to gain market share. But now they're saying no longer, like we have to, there's a limit to what we can hold.
And the point is, a lot of the stuff that you get at Walmart is made in China.
Yeah, I mean, they'll tell you all about the things that they make in the U.S., but a lot of their stuff, particularly areas that were down, sporting goods, general merchandise, things like that, those are being hit by the higher prices.
And it's interesting within Walmart's results, and this is something we were talking about with Chuck Crom, that there was this very much a shift towards the staples. It was pharmacy, it was grocery that was really holding up, whereas general merchandise, it seems, was slowing down a little bit. I guess people aren't buying pool noodles necessarily, and you look ahead to what's still to come. Costco, Target, BJ's coming up in the next couple weeks. If Walmart is looking at price increases here, what are their peers thinking about?
Yeah, I think it's going to be worse for the rest of the lot. I mean, they had already been warning last quarter that things were not, started to prep their investors that things were not all going to be groovy there. And so now Walmart is saying, okay, things are not looking great for us going forward. We're going to have to start increasing prices. You will probably see that in spending numbers with consumers, pulling back a little bit. And so if that's what Walmart is saying, you can imagine what the likes of Home Depot and Target and the other companies are going to say.
All right, Shelly, thanks very much. Shelly Banjo there covers global companies for us. And we're back with Stuart Kaiser. It's interesting, the small caps, when I talk about all the stuff that comes from China at Walmart, I think the small caps must have a lot of China exposure as well. But why do you like small caps right now?
I mean, we like small caps very, very tactically. I mean, the fact is you've had this huge rally that was so narrow and gappy that a lot of investors weren't able to participate in it. So what they're looking for is, if I get this sort of next leg of the rally, what's lagged and what might catch up? And smaller cap, lower quality, kind of weaker credit risk type of equities and companies we think do have that potential. But again, that's a very tactical trade. It'd be very hard to recommend people get into IWM or small cap over the medium term, given the latent recession risks that are out there.
But that is the way you like to trade it. I mean, Katie's ears just perked up. What's the ETF? IWM?
IWM, yeah.
Yeah, that tracks the Russell 2000, which people like to tell us is a junkier sort of index. We were having a great conversation with Ron Temple actually the other day of Lazard, who was saying basically what you're saying, that you have to be very, very active. There's a lot of security selection that goes on. You like to trade it tactically, but I have to ask, is the juice worth the squeeze? Because it sounds like a lot of work.
Yeah, I think that's an open question, I would say. I mean, if you can look within the Russell 2000, there's probably 700 of those 2,000 stocks that make money. So you do have the upper part of IWM is pretty high quality, and we do see some people doing stock picking in there. For a macro investor, you're just buying the whole index, and you're really hoping for either improving growth, lower rates, or just kind of a risk-on positioning squeeze. And I think right now it's much more on the positioning side that people are willing to engage in small cap. I think the difference now versus, let's say, December of 23 or last July is you had such a short base in small cap that you had a lot of squeeze risk to the upside. I'm not sure that positioning dynamic is in there. So to your point, risk reward is kind of a little questionable, and I think that's why it's had a little bit of trouble getting its footing.
You also like tech hardware, which is another one where I think, wait, isn't that stuff that's made in China as well?
Well, the China news is good, right?
Yeah.
So look, I would say that the three areas: weaker balance sheet and small cap, consumer durables, which has been right in the crosshairs of tariff risk, and tech hardware, are just three parts of the market that have lagged during the tariff headlines.
They've got punished a little too much.
Well, and if you're an investor who kind of missed some of this rally going, those are areas that might play some catch up. But again, those are like very tactical things. I think that's a 1 or 2 week trade. Bigger picture, we would be in growth stocks, and that's the area we're more comfortable kind of running medium term equity risk right now.
Let's talk about growth stocks and specifically tech, because you think about the last few weeks for tech, they've led the rebound. And you take a look at the Nasdaq 100 specifically, it actually entered overbought territory on its relative strength index, I believe, yesterday. When you talk about being tactically, do you think that we might lose a little bit of momentum when it comes to this tech rebound?
It's possible, but look, like our growth factor is up 21 out of the last 30 trading days. I mean, this has been a very steady, kind of clean trade to the upside. And the view here is, in the beginning of the year, given all the uncertainty you had, you would have liked to have hidden in growth stocks. The problem was they were very, very expensive, and they were very overowned. both of those things went through a pretty, a painful correction in late February into March. So our view was after that correction, this is defensive again and you can hold it. To your point on the overbought, if you're starting to get back to that position, then you're kind of rewinding back to where we were in February. And maybe you do then have positioning and valuation risk. We don't think you're fully there yet. So we do think there's still more room for growth to work. But that's going to be the ultimate question. It's not the strength of their balance sheet. It's not their earnings growth. It is positioning and valuation that will get people to kind of fade that trade, I think.
And outside of trade, Matt, we should note that coming up is NVIDIA earnings on the 28th of May. So you think about catalysts here. Here's a big one.
Yeah, that's a huge one, I guess. I go back to that conversation we had with Ron Temple of Lazard. And one of the interesting points he made about small caps is that, as Katie points out, it's a lot more important to be active in small caps than it is, say, in the S&P 500, obviously. In times of volatility, is it better to be more active, right? We've seen this huge drawdown and now a bounce all the way back up. Or is it better to kind of keep your fingers away from the stove and just track the big index?
Look, I mean, in this case, as painful as it was probably better just to stay invested. We had a quick note over the weekend that the entire 17% rally, you could have captured in 60 trading minutes if you had just timed it perfectly. So in that sense, it was very hard to be tactical because you had to be so precise and surgical and right to catch it. And I think that's really what's really frustrated a lot of institutional investors is you rallied so hard off the bottom, but really if you didn't own a few little 15-minute intervals, you just weren't able to take advantage of it. So I think folks were trying to be tactical and trade the headlines. In this case, the degree of difficulty to being right was just really unattainable.
So is stay invested the lesson we learned? Because Ken Griffin was telling Shanali on Monday it would have been better to be in cash.
Look, it depends on your investor type and your holding period, right? I would say long-only investors, your sovereign wealth funds, your pensions, they were looking for opportunities to engage in the sell-off because they have a holding period that can endure that volatility. As you know from our hedge fund and macro directional investors just don't have the luxury to kind of buy and hold, and unfortunately that made this a really difficult trading environment for them.
Cool. Stuart, great to have you as always. Citi's Stuart Kaiser there talking to us about the stock market, and now Katie's going to take a look
I'm going to do something
at the
special.
Stock market.
I'm going to take a walk and talk here. I want to break down this market and take a look at the breadth. We had very light breadth to the upside yesterday, still managed to close in the green. Right now, you have the S&P 500 off by about 0.3%, and pretty much an even split when you take a look at what's gaining and what's losing, both to the upside and the downside. Let's look at specific stocks here. It's very much still earnings season, and you can see that in Cisco. This is your biggest contributor to the upside right now. They actually boosted their full year revenue view, which has been a rare sight to see in this earnings season. You also have JPMorgan higher as well. That's the upside. Take a look at the downside. This is why we're lower, and it's because Amazon is off by 2.6%. That is taking 6 points off the index. And then you have United Health's bad week continuing to get worse with that Wall Street Journal report about potential investigations here. You can see United Health down about 16%. And this is broadly what you're going to see if we take a look at the sector view as well. This even split on the sector level. Utilities up in the green right now, real estate and financials as well. Pretty defensive tilt all told. And then you take a look at the downside. We have healthcare, consumer discretionary, and energy off by about 1.4%. Now, coming up, we'll talk about CoreWeave, also in the earnings season. Profit missed estimates as it pulls forward its AI spend. We'll give you all the details next. This is Open Interest. All right, it's time now for Top Calls, some of the analyst action in focus this morning, and we start with Cisco, getting upgraded to a buy over at Wells Fargo on AI optimism. The company boosted its full-year revenue guidance. It also beat on estimates when it reported after the bell yesterday. You add it up together, and shares are higher by about 5%. Next up, we have Pinterest getting upgraded to a buy over at Wolfe Research. The analyst cites improving fundamentals and said that the valuation is highly reasonable, but shares pretty much unchanged right now. And finally, JetBlue getting downgraded over at Raymond James. The firm sees a more balanced risk reward after it was upgraded last month. And Matt, currently the shares are down by more than 5%.
All right, JetBlue then taking a hit today, but I want to swap to tech right now. CoreWeave is bringing forward some spending to meet consumer needs that weighed on earnings in the previous quarter and suggests AI spending could be higher than anticipated. You can see those shares down about 5% now as well. Bloomberg Technology co-host Caroline Hyde has the detail on this stock, which actually has been killing it since the IPO, right? It's up about 60%.
You're right. And maybe that's why I see a bit of profit taking, because I have to say, top line growth, revenue, phenomenal. When you're seeing more than 400% growth, people like that. People like the talk about demand, the OpenAI contract signed, the signaling of another $4 billion contract, which they wouldn't name the buyer, but already Moffett-Nathanson saying, we're assuming it's Alphabet. This is a company that is therefore, though, having to spend to meet that demand. The spend, the CapEx guide of $20 to $23 billion just irks some. More broadly, when this is a highly levered business and already they've just done their IPO, they're going to have to sort of put investors' minds at rest as this CapEx is going to be fulfilled by ultimate demand coming from these players. They're going to be building out, they're going to reap the rewards, but it does dent profit in the here and now, and that's probably why you're seeing shares tick down a little bit. Their forecast for operating income is 140 to 170 million. The market won 190 million. Remember, this is actually still posting losses as a business.
I will point out, and I said this when they IPO'd, I'll say it again, one of the co-founders went to Haverford College, and there's not many of us. It's a very small Quaker school. So you're interviewing the CEO of CoreWeave later. You're
Is he the guy? Is it a different co-founder?
No, it's a different man, unfortunately.
Not Mike.
I am curious, though, what will you focus on in that interview? When you take a look at these results, you take a look at the sell-side reaction, what sticks out the most to you?
Well, I think we do need to ask him about vindicating the capital expenditure. We want to get a hint on who that ultimate purchaser of the last $4 billion was. I think what's going on in Saudi Arabia is going to be really interesting, though, as well. Remember, the fact that we're seeing more and more promises of generative AI, sophisticated chips being able to go to the UAE and to Saudi Arabia, we understand there's concerns about how much of a controlled environment those data centers are. What does Mike say about that? He's going to be the perfect person to say, look, you can stop China accessing overall the cloud compute or indeed the chips more directly. He's going to have such expertise.
eToro is another recent IPO.
Oh, IPOs are back.
And it's also kind of the new school of financial stocks. What do you make of it?
It's like a social media meets trading app, basically. You can follow people that you want to replicate.
Yeah, you can replicate their strategies.
Exactly, and whether it's in assets of stocks or in crypto. So we've got the founder, the co-CEO coming on a little bit later as well to talk about how they saw, I think, 20 times demand for the shares than they ultimately placed. We're seeing the shares rocket yesterday. Yes, they're pulling back a little bit today, but this is what it means for the rest of the market. eToro, of course, delayed during that ultimate April 2nd onwards anxiety around tariffs, but they came back. We now have Chime, another fintech, which at one point was worth $25 billion when it fundraised back in 2021. Will they be able to come to the market? They're anticipating early June for an IPO. Your friend over at Mountain,
Mark D.
I'm not talking about Ryan. I know you might be bezies with Ryan Reynolds too. He's the chief creative officer, but they're looking to tap the market, get about $1 billion valuation. We're starting to see this creak open of the IPO market. What's so interesting, though, is you've been watching CATL over in China.
Cattle, yeah.
This is literally the stereotypical eye of the storm geopolitical company. It is an EV battery maker, supplier to Tesla, but a Chinese company that the Pentagon said overall was in some way related to the military and should be blacklisted. But Bank of America and JPMorgan are on that actual Hong Kong placing. It's going to be the biggest IPO of the year in the world. $4 billion it could raise. And again, demand off the charts. They're even saying, look, we can do Reg S. We don't need you retail US investors. We can avoid some of your regulatory
Well, it'll be fascinating to see how that one goes. I will say when it comes to eToro, and it comes, of course, to CoreWeave. So you had eToro, they were upsized, their IPO. CoreWeave,
opposite.
Which, it was the opposite. They had to downsize. Of course, what did they go public? Early April, the end of March. Feels like the environment has just so drastically shifted when it comes to sentiment around IPOs.
But I also wonder, that was a very idiosyncratic story about generative AI and the demand. Do you remember when they came, we were all still talking about a bubble in AI infrastructure that Alibaba CEO was talking about?
DeepSeek fallout.
All of the Microsoft concerns they were pulling back on their data centers. That's be another key question for Mike in Trader is like, how much are they seeing Microsoft actually coming back and needing that compute with them? Because they said, look, Microsoft did pull back, but Microsoft in their earnings said, we're still undersupplied here in terms of data centers.
Right.
So I think that they did have a tough time coming into the market, but as you say, up and to the right ever since, up more than 60%.
All right, Caroline, really looking forward to your program.
Thanks.
Caroline Hyde, anchor of Bloomberg Technology. She's going to be speaking to the CEOs of CoreWeave, not the Haverford grad, but the other dude, and the CEO of eToro on Bloomberg Technology today at 11 a.m. Eastern, right after this program.
Now, coming up, a bombshell criminal probe into United Health is crushing the stock and weighing down the entire S&P 500. We'll give you the details next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on with stocks. 22 minutes into the session, we're looking at red arrows after the solid close. I guess positive close yesterday, and really a solid first three sessions for the S&P 500. So even when we're down 0.5%, we're still at 58.67, which is better than a stick in the eye and still higher than what we saw on April 2nd, on the close on April 2nd. The Nasdaq down about 0.6%, as well as Katie said, we're really waiting for NVIDIA. It's still a couple of weeks until NVIDIA comes out with earnings. NYMEX crude is one we don't always reference here, but off another 2.33%. It's a 61.68, so not at the lows that we've seen this year, but really taking a dive after President Trump said Iran may make a deal. In terms of the stocks, a lot of earnings news here. Cisco, Deere, CoreWeave, and Walmart. Then United Health Group has been a huge weight, especially on the Dow Jones Industrial Average, where it was the heaviest stock on the index. Now the reports that they may be probed by the Department of Justice, really taking another 16% off of the stock, Katie, so a huge hit.
Yeah, let's talk a little bit more about that bombshell report. That coming from the Wall Street Journal, that United Health is under criminal investigation for possible Medicare fraud. Bloomberg U.S. healthcare reporter John Tozzi joins us now. So for their part, United Health said in a statement late Wednesday that the Department of Justice hasn't notified the company about the reported investigation. So there's still a lot of questions out there. But what do we know so far, John?
Yeah, so as you said, the Wall Street Journal reported last night that the company is under investigation for possible criminal Medicare fraud. That would be a new development. We know that there have been investigations on the civil side. There's a long-running civil case around their Medicare Advantage practices. This is an area where we've seen increasing enforcement from the government over the past few years around how insurers bill the Medicare system in their Medicare Advantage plans, which has been a big driver of growth for the industry until recently.
So United Health has said that they have not been notified by the Department of Justice of this supposed criminal investigation, and that they stand by the integrity of their Medicare Advantage program. So just to be clear, the company essentially denies that it's participated in any kind of fraud. But what would Medicare fraud look like? What are these allegations actually about?
Yeah, so the way this business works is that when you sign up for a Medicare Advantage plan from a private insurer, that plan gets a premium from the government to provide your Medicare benefits. So they get a monthly payment for all of your care. And that payment is adjusted based on how sick you are. If you have cancer or diabetes or other conditions, the government pays them more to take care of you because your expected costs will be higher. Now, that system has been the subject of a huge amount of controversy because of the way that insurance companies and medical clinics can record diagnoses.
Right.
You know, they have the incentive to sort of record all the diagnoses they can. They get paid more, and there are cases and allegations involving other companies that they have sort of inflated or exaggerated how sick their patients are to increase their payments. So that's the kind of activity that we are potentially
talking about.
Yeah.
Right. Okay. Although, of course, they deny it, and we want to repeat that. John, thanks very much. I know you're going to continue, probably head back to your desk and hit the phones again, continue to report on this story. John Tozzi there on United Health.
I will just point out that United Health down 48% year to date. You take a look at the sectors year to date, and you can see that reflected because healthcare is now your worst performing sector in the S&P 500. Such a different outlook from where we stood at the beginning of 2025.
Yeah, interesting also because it's a defensive sector. So
right.
Today and yesterday, it really should have been getting gains. When we come back, we're going to talk to Sonders of Charles Schwab. Stay with us here on Open Interest. We are 30 minutes into the trading day, and we're looking at some losses on the benchmark indexes. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. And Matt, I think it's telling here that the Nasdaq is actually seeing a bigger drag than the Dow and the S&P, despite United Health, despite Walmart. A lot of things to look through on a single stock basis, but also sentiment turning a little.
Yeah, very good point, especially considering the weight of United Health. I mean, it was such a heavy stock on the Dow, but it's lost 50% of its market value year to date.
We'll talk all about it. But coming up first, we're going to get fresh clues on the consumer. Walmart's earnings beat, but the retail giant warns that tariffs and economic turbulence will lead to price increases.
Meanwhile, billionaire Steve Cohen puts the chances of a recession at about 45% amid a significant slowdown in growth.
And JPMorgan CEO Jamie Dimon also weighed in on the odds of a recession earlier today on Bloomberg.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India. We want you.
Economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
All right, joining us now is Sonders, Chief Investment Strategist at Charles Schwab. And Lizanne, we heard a little bit from the president there, and we'll get to him in a moment. But we want to focus first on your expectations, your investors' expectations for the U.S. economy. Obviously, the recession fears were heightened when we had 145% tariffs on China. Those have been lowered significantly. And now I thought we could sound the all clear, but apparently not. What's your view?
Well, I don't see this as an all clear. It's certainly the de-escalation is better than what was in place prior to that. But we have to remember that some of the economic data, the forward-looking nature of it, meant that you were seeing rising recession risk even back as early as the peak in the market in mid-February. So I'm not. This all else equal is better news, the de-escalation, but the uncertainty factor, which is really what has constrained things. It's caused many companies to just withdraw guidance altogether, to pull back on capital spending and other long-term investment plans. I'm not sure the outlook is that much clearer that you start to see an alleviation of what that uncertainty has caused companies to do, particularly with regard to forward guidance and things like long-term investment plans. So, I think a re-rating of recession odds may make sense, but I don't think they've been eliminated to any degree.
We're getting a lot of information, Lizanne. You think about Walmart warning that prices could be seen by consumers at a higher rate. You also have retail sales barely rising. You have producer price information. What is the current data telling you about the direction of travel, knowing that not everything yet is priced in?
Yeah, it was an interesting batch of data today. I would say it was mixed. Retail sales on the weaker side, particularly control group, which is the component within retail sales that maps directly to GDP. Speaking of mapping, what was also interesting is that the lower than expected PPI today, the embedded components, particularly portfolio management fees, suggest maybe less upward pressure on PCE, because in the aftermath of the CPI data, what you could map from there to PCE suggested we might see actually a little bit of a lift in PCE, kind of going against what the CPI data said. That alleviated a little bit with regard to PPI. But then you had Empire come out today, Philly Fed come out today, and it was interesting. You saw a pickup on the new order side, suggesting that some of that tariff-related, trade war-related front-running is still alive and well, and it's going going to take a little while before we get any true clarity on this data. I think what Walmart may be expressing here is that with all the front running that we saw already in terms of getting ahead of tariffs, that built inventories at a fairly low cost basis. And I think the point we're in right now from a consumer oriented company perspective is this gives them some leeway to experiment with what price increases are likely to be and what can stick. So I think the data is going to continue to be murky, at least for the next month or so.
Are there any red flags on the consumer yet, Liz Ann? I mean, we're always worried about the U.S. consumer, and at the end of the day, the U.S. consumer usually surprises us on the upside. Do you see data like credit card debt or a drawdown in checking accounts or anything like that gives you pause?
Some of the delinquency data is getting to more troubling levels, so I would keep an eye on that. But I think what really holds the key for the consumer is trends in the labor market. We learned that over the last several years, particularly back in, say, 2022, when we were in a bear market in stocks and recession odds were very, very elevated by virtue of the fact that we had, a 9 handle on CPI, the most aggressive tightening cycle on the part of the Fed in 40 years. But the prior period had allowed a lot of households to shore up their balance sheet. They still had a lot of excess savings. So you were able to ride through that, coupled with the fact that we were in that labor hoarding mindset on the part of companies. So we never got the labor market hit and allowed consumption to stay at healthy levels. That's really key now. It's not just key to ongoing ability for the consumer to hang in there, but also as it relates to Fed policy. Because I think the Fed, in light of their dual mandate, may have a little bit more of an eye on the labor market side of their mandate than the inflation side of their mandate. So it's all wrapped up in this labor market bow. I think it's that data, particularly of the leading variety, that will be the tell. Claims today does not suggest we've got serious problems, but that's what I have my closest eye on.
All right, great to get the intel from you, Liz Ann. Thanks so much for joining us. Liz Ann Sonders there.
Thank you.
Of Charles Schwab. Meanwhile, you saw President Trump there briefly. He is in Abu Dhabi today, continuing his tour of the Middle East. He spoke earlier asking Apple to stop building plants in India. We already heard that sound. Let's get straight out to Annmarie Hordern. She's standing by with an assessment of, I guess this trip so far has for the most part been about deals. Why is he bringing Apple into this? What is the concern with Apple right now, Annmarie?
Well, the president was talking about India and how India is ready to lower their tariff rates, the president said, effectively to zero. So almost insinuating that what Tim Cook and Apple were doing were taking advantage or about to take advantage of lower tariff rates in India as they move and talk about moving their supply chain and production of iPhones from China to India. And the president said he's having a little bit of a problem with Tim Cook. And he spoke to him. He said, we don't want you making your iPhones in India. We want you to do that in the United States. What's interesting is the president has been flanked by executives throughout this entire trip, from Riyadh to Doha. We saw that this morning. On the side of him was GE Aerospace CEO, as well as the Boeing CEO, and as well now in Abu Dhabi. The individual that's missing is Tim Cook of Apple. And the president also called him out on Tuesday in Riyadh, speaking to investors and these business leaders. He said, Jensen Huang, my friend, I see you. You're in the audience. And he's like, Tim Cook's not here, but you are. So it seems to be the president is having a little bit of frustration right now with Apple and Tim Cook. We've heard his name twice, and that individual is clearly missing on this Middle East tour for the president.
Annmarie, something that strikes me is how much business leaders are stealing the show in the middle of this Middle East trip. Presumably, it should have been government officials, that this was really what it came down to, the talks that he's having with people that we're working on trade deals with as well as security deals with. Where does Trump actually stand on India right now? There is a notion that they've offered to remove all tariffs, yet this Apple news is certainly a threat to India too.
Well, right now, Trump has talked about how there's dozens of trade deals, he says, in the hopper, ready to go. We do know that India was one of the first movers alongside Japan and South Korea to come out and try to find some sort of agreement with the United States. This started very early in the first 100 days of the Trump administration. Right after he was inaugurated, we saw the Prime Minister Modi come to the White House, and that's when those conversations on trade started. So I wouldn't be surprised if India in the next few weeks, as we are still in this 90-day reprieve pause that ends in early July when it comes to those reciprocal tariffs from April 2nd, if India is one of those countries that gets to some sort of agreement, especially as the president on his trip to the Middle East and in Doha is talking about the fact that India is ready to bring their tariffs lower, sounds like they're ripe for a deal.
All right, Annmarie, thanks very much. Bloomberg's chief political correspondent, co-host of Bloomberg Surveillance, Annmarie Hordern, there on tour with President Trump. We should mention that the president also has said that we are closer to a deal with Iran, and that has driven the price of oil down 2 to 3%, whether you're looking at Brent, whether you're looking at NYMEX. So that's, I think, a developing story that we're going to be watching really closely here.
Yeah, absolutely. And you have to wonder if they'll get to that sweet spot that Goldman is looking at, 40 to 50 bucks. But for now,
sweet spot for some.
Sweet spot
not
for
some.
Others. Yes, exactly. And you have to wonder if it's a recessionary signal underneath the surface as well, or if it'll really start to set off more activity. But let's also get a look at some of the stocks moving under the surface this morning. Boeing higher once again. It's a sweet spot in the market today as well, landing its biggest ever aircraft order from Qatar Airways. This is news extended from yesterday. You're seeing another 1.3% gain today. Walmart, we've been talking about it all morning, 3.4% lower on the day. Of course, Walmart is the giant in the room here,
Yeah,
Matt.
but they had same-store sales that were up. They had earnings that beat, and they're talking about raising prices. It looks like the consumer can handle that. I think it's interesting that they're down 3.5% on this. And then Dick's getting absolutely crushed after almost $2.5 billion acquisition of Footlocker. They are paying an 86% premium, I think it is, to yesterday's closing price, and investors really punishing them for it.
Yeah, and it's amazing that 86% premium probably reflects what the longer-term price had looked like. But of course, a lot of retailers getting smashed in this market. But coming up, we're going to speak to somebody else who knows a lot about exactly what's going on under the hood in Wall Street. We're going to bring in King Street founder Brian Higgins, why he thinks the biggest risks are now off the table. That's next in the Wall Street Beat. This is Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. Global trade chiefs are gathering in South Korea, and they're trying to get FaceTime with U.S. Trade Representative Jamieson Greer. Greer spoke with China's Vice Commerce Minister Li Qiangong less than a week after the U.S. and China agreed to temporarily cut tariffs. Bloomberg caught up with Qiangong at the event.
Minister Li, how did the talk go with Greer?
Good talks.
What topics did you discuss?
Topics on trade?
Are you going to talk with him tomorrow?
Probably not.
When's the next talk with Greer?
I don't know yet.
Will President Trump and Xi have a meeting?
I don't have any information.
How about a phone call?
I don't have any information.
All right. Other member state trade officials are also expected to seek talks with Greer to try and blunt the impact of Trump's trade policies. Fed Chair Jerome Powell says that policymakers are weighing changes to key parts of the framework that guides their monetary policy decisions, including how they think about shortfalls in U.S. unemployment and approach the inflation target. Powell acknowledged that the current framework was designed at a time of persistently low interest rates and low inflation. Powell made the remarks at a research conference on the Fed's monetary policy framework. Shelly?
And Matt, time now for the Wall Street Beat, because joining us now, King Street founder and managing partner Brian Higgins. King Street has 30 years of experience in investing in credit and manages about $28 billion of assets. And I wanted to start with you with exactly that, the bond market. I wanted to start with you with the 10-year yield, because a lot of people are noticing that this kind of nearly 4.5% level on the 10-year, roughly 5% level on the 30-year, it's sticking. And that is something that you have to imagine the Treasury Secretary is watching quite closely.
For sure. Thanks for having me. Always a pleasure to be here. What's happening is the market is taking this wait-and-see attitude on inflation, on the budget deficit, and it was told that with DOGE, with cost savings, with the tariff income, there would be a reduction of the deficit. And they understand there's $10 trillion to be refinanced, and there's certainly a lot of competition for capital.
Well, that refinancing is what gets me a little bit, because if you have a budget deficit that you're sitting with and the cost of interest alone is looking at a 4.5% 10-year, you've got a problem on your hands.
Well, you have a problem. I mean, it's never a problem. Ultimately, there's always a buyer for U.S. Treasuries. I think what happens is it makes it expensive for everyone else to do business, at the base rate being where it is. It is an attractive time. You are being compensated to be in fixed income. Now, spreads have rebounded since Liberation Day. They've done a round trip, and so you have 350 over for high yield and record tights for both investment grade and high yield. However, and what's that saying to you? It's saying to you, well, risk of recession is 10%. However, if you look at small cap stocks, for example, they're saying risk of recession is 50%. So when we talk about dispersion, it's just dispersion of outcomes, dispersion of assumptions as well. And so that uncertainty, while it has come down, I think part of it is the tail risk has been truncated. It was such a wild, how do you factor in 100% inflation tariffs, which cause inflation and slowdown, to a more moderate level. But again, it's still devil in the details as we are waiting to see what the final, these are back of the envelope or handshake agreements. Trade agreements many times are 2,000 to 3,000 pages long and take a long time to negotiate. And so I think a number of industries are, if you look at soft data versus hard data, there's still a question as to where that comes out. The initial soft data was everyone suspended guidance and said, I have no idea. And so if you poll them today, I think they would have a more constructive view. However, the hard data, we'll see if that follows. So far, it's been strong. Earnings been strong first quarter. Yeah. Defaults are still really low. Credit spreads are low. So CPI was good, but PPI, I think, as they said, they're holding the line but their margins have been impacted. And so you saw Walmart say, hey, wait a minute, we don't know how long we can hold this, which would then impact the consumer, which then filters into the hard data.
Well, and if they don't raise prices too much, it really doesn't matter, right? I mean, the question is how much are they going to have to raise prices at the end of the day? Where are these tariffs going to end up? Do you have any view into that?
I think I'm with everyone else, which is a lot of uncertainty on.
But is 10% really a floor, Brian? Do you think that's what Scott Bessent told Surveillance at the beginning of the week? Is 10% really a floor for not just for the Chinese, for everybody? Is that where Donald Trump is going to keep tariffs for the remainder of his presidency?
It appears to me the administration is using uncertainty to negotiate, and so I think to say that it's going to be 10%. However, if there are certain outcomes which aren't as they were agreed upon or had hoped for, perhaps they would reserve that right to increase them. Again, I'm not involved in this situation, so there's a very difficult prediction. However, I do think if you say 10% is an assumption, then certainly it'll be a more benign impact on that. However, there's still housing affordability is at 30-year lows. And you think about the durable goods, people are still worrying about the uncertainty there, what impacts. So there's still a lot of inflation on the soft goods, and durable goods and consumer cyclicals are still under pressure. And with higher for longer, as again, as I said, infrastructure, utilities, energy, there's a lot of these CapEx spend that need to be done. So again, that competition for capital keeps the base rate and spreads at a healthy level.
Brian, I'm really curious. I want to bring up what we're seeing in terms of bankruptcies, because you have been seeing not alarming levels here, but a tick higher, particularly in those sectors that you're talking about where the consumer is more impacted.
By the way, I was alarmed about bankruptcies until I saw the longer-term chart.
Yeah, it
now
doesn't
not
look
so much.
historically nuts, but it's never a good thing when you have companies either start to file for Chapter 11 or go back to restructure, which we're starting to see a lot of that happen. So it's not even reflecting all the pain. Where are the cracks forming?
Well, if you look at the broader syndicated loan market, the B- is 28% or something, record levels, and so private credit and the broader syndicated loan market would be our new issue market where we're going to see opportunities. We do a lot of liability management exercises. So there's opportunities to restructure outside of the bankruptcy context. Bankruptcies have been low because of fiscal and monetary policy have been very easy, and it's been a tailwind. And rates have come down and then have gone up dramatically, but not enough to impact these companies. And there's been money supply has been very abundant, and so enabled. There's not a real problem with getting capital. So there's been record amounts of money raised in the credit markets, for example. And so that's been able to go in and finance all these companies. However, as I said, when it's higher for longer, that does come into effect. The consumer has been doing just fine. However, they're starting to get weaker. We've been talking about this for quite some time. On the lower middle end of the consumer market, that is getting pressure, which is then followed through into bankruptcies. But for the moment, it's still being out of court, which means a lower bankruptcy, more of the out of court. But putting together, that is a higher number, but still lower than the trend.
The translation is, even though companies are not going into bankruptcies, they're still going to credit companies and saying, well, wait a minute, we got some problems
we
here.
have to restructure, or we will go into bankruptcy.
Right?
Yeah, that's, I think, a lot like the hard data, or soft data not translating yet into the hard data, and maybe it will. I have yet to really wrap my head around this Federal Reserve story, but Jay Powell apparently at a research conference said they're considering changes to their framework in terms of how they think about shortfalls in employment and their approach to the inflation target. What's your view of the Fed and how they assess things right now?
Well, there's been a lot of criticism by the current administration on the Fed, and I think it's important just to say that over the life, over the last couple decades, there have been a lot of issues that they've navigated well. There's a lot of question as to why had they lowered rates last fall versus not lowering now. I think it's, again, the question of the tariffs. Certainly, I think there's an question on monetary policy from the Treasury's view. Why not extend out duration when they could have? So there's been a lot of second guessing. These are difficult jobs.
But the important question is, what do you think the Fed is going to do now?
My view would be they're going to wait. If you think about rates where they're going to 4 to 6%, given the data, they're going to have to wait to see how the budget negotiations go with Congress, which reached the debt limit in August. They're going to see how some of these tariff negotiations go. There's a lot of uncertainty, and policy, Fed policy, central bank policy, it's like turning a super tanker. It's not a speedboat. So you can't tack back and forth because it takes a while to go through the system. There's a lot of expectations that are met.
Brian, we're hitting a break. We thank you so much for joining us today. That is King Street founder Brian Higgins. Of course, a complicated moment in the market. This is Bloomberg Open Interest.
Get a quick check on markets right now. S&P 500 just about an hour into the session off 0.2%, and the U.S. 10-year yield coming in just below the danger zone at 449. This is Bloomberg. One of the world's most dangerous sports is making a major advance in safety. It is the first league, Moto America, to use Abbott Labs' rapid blood test for concussion evaluation. It'll be on site for all Moto America races this year. The test is able to identify mild traumatic brain injuries in 15 minutes. Joining us now is Richard Varner, Moto America Chief Financial Officer, and Dr. Carl Price, Moto America's Chief Medical Officer. Gentlemen, great to have you on the program. I obviously am a longtime fan. I've been watching Moto America racing for over a decade now. Let me start by asking you, Doctor, about this test. It's interesting that you guys in motorcycle racing have adopted it first. I would have thought it goes to football or boxing. How important is it for motorcycle racers, for you as a doctor that serves these pilots, to be able to assess whether or not they've had a concussion?
Well, Matt, thank you. It's a pleasure to be here. I have a little bit of a vested interest in this, in that I am a racer. I've had numerous concussions, and concussion is actually a clinical diagnosis until now. It's a constellation of symptoms, and many of those are self-reported. And so it's a fairly subjective diagnosis. This blood test, which measures a couple of different kind of biomarkers in the peripheral blood, is the first bit of objective evidence that we have. And when I first heard about this test, I've known about the biomarkers for a while. Although previously you had to do these in a reference lab. Essentially, you had to draw blood, spin down the blood, get the serum, and send that off to a lab. And it wasn't very helpful at point of care. Last year in April, the FDA approved Abbott's iStat Alentity device, which is a handheld computer that you basically put a drop of blood on a chip and plug it into the computer, and it spits out the answer in 15 minutes. And it was a result of a private-public partnership between the DoD and Abbott. Bottom line is it measures these biomarkers, and right now it's approved by the FDA. It allows us to determine whether somebody with a concussion, we need to send them for a CT scan or not. So, which is helpful just from a triage standpoint in my situation, but it also has some other uses that I'm using it for in terms of helps me quantify a little bit the degree of concussion. It also lets me, being a writer, I kind of know sometimes that the writers don't really want to know they have a concussion, but I can do the blood test and show them and say, hey, look, you really do have a brain injury and you shouldn't be out there. So it's real exciting, and it's we're just the first sports organization, motorsports organization, certainly in the world, using this as part of our concussion protocol because it's a huge game changer.
Yeah, well, and safety is so important. Richard, let me ask you about the improvements that you've been able to make. Obviously, motorcycle racing can be dangerous. Your CEO, Wayne Rainey, had a horrific accident in the Misano Grand Prix in 1993. And people don't want to see that, right? As you make these kind of safety improvements, how helpful is that, to attracting viewers, longtime viewers for the sport?
Well, thank you very much, Matt. I think not only is it important to attracting viewers, but also participants. We feel like the future of motorcycle racing is in our youth. And as they grow, we want the parents and everyone around them to feel comfortable that we're taking every opportunity possible to keep the riders safe and to have on hand the ability to determine if they're injured, truly injured, or if they're safe to go. Because it's not only the rider that we're concerned about, it's the riders around him or her. And I think it's a testament to Abbott Labs and that's developed this and are putting it out here in our field to make sure it works and well tested.
Dr. Price, could you give us some information also on what you're solving here? What are some of the numbers that you're looking at when it comes to the accidents that you're seeing in the sport, and how much doing this could save lives, frankly, if not at least careers?
Good question. Can you quantify it?
Well, I think that, concussion is a big part of our sport. On any given weekend, race weekend, we'll have 2 or 3 concussed riders. And once again, this helps us manage those concussions and potentially let us perhaps diagnose them a little more accurately and have some more rational return to sport decisions too. That's always the difficult part when there's someone after a concussion, when they were able to return to sport, because obviously one concussion, multiple concussions is bad. And we want to make sure that our riders have a life when they get done with this. And so, I think it really does help us be a little more sensitive in terms of our ability to diagnose and manage those concussions. I'll just kind of say it's real gratifying to be a part of an organization that Richard's put together that really is interested in rider safety. Not only are we doing the concussion testing, we have airbag suits that we've instituted, Road Racing World Air Fence at the tracks, which are barriers to help prevent injury. So we're doing a lot of things to kind of prevent injury, as well as managing injuries like with this concussion test.
Richard, I want to ask about the diversity that you've brought into motorcycle racing, and I don't mean in terms of your typical DEI thing, but the actual bikes, right? We've got a Super Hooligans class at Moto America, which I absolutely love. And then King of the Baggers has been a massive success. I was lucky enough to get to ride Harleys with James Rispoli and the Wyman brothers in Austin a couple of months ago, and I'll never forget it. How much more can you expand with these racing classes? And will you continue to have King of the Baggers as Harley goes off to ride with MotoGP next year?
Well, let me answer the last question first. Yes, we will continue to have King of the Baggers. As you may have noticed, Harley's endeavor in Europe will be strictly a Harley-Davidson class. There won't be any other makes. So we race both Harleys and Indians and feel it's important to have multiple makes in our championship. In terms of, expanding the offerings that we have on the track, our biggest issue is we provide 5 or 6 classes a weekend of racing. So it's very difficult to manage the time over a weekend to get a whole lot more classes in. So we have to be very careful. But we've seen huge growth in the hooligan class, and we're seeing very strong showings in the bagger class as well. So I would say, and stock 1000 is very large. So I would say that as long as we continue to track those people, we'll continue to run them.
All right, Richard, thanks so much for joining us. Richard Varner there, and Dr. Carl Price of Moto America. Great to see Laura's badge riding on those baggers as well. I mean, I'm sure it's all Greek to you, but to me, seeing these like World Superbike and MotoGP guys start to ride big Harley baggers is just super exciting.
I mean, I'll be honest with you. I think it's very, very cool. The reason I'm nervous about baggers is because I still have a scar on my ankle from a dirt bike accident when I was 15. So, you know, we're gonna stay off the baggers for me. But
at least stay off a road glide. Yeah, for sure. Exactly.
Anyways, we're gonna check on these markets, Matt. What are we taking a look at?
Yeah, we are looking at an S&P 500 that is slightly lower, but we've had a pretty good week, right? I mean, Monday we were up 3.25%, then 0.75% on Tuesday. We're still at 58.69, so not above that 5,900 level that we bounced off of yesterday, but much higher than we were at the close on April 2nd.
Absolutely. And we're at near that danger zone on the bond market as well, as we've been talking about. But I want to look at some single stocks under the hood right now. We're looking at United Health. It is lower following a report from the Wall Street Journal that the company is under criminal investigation for Medicare fraud. You're seeing United Health down more than 17.7%, and it has been a brutal year for the company, as we know. But watching Cisco, that's a brighter story, up more than 6%, rising after boosting its full-year revenue guidance. So business spending holding in strong. That AI story starting to shine a little bit. And Dick's Sporting Goods falling after announcing it will be buying Footlocker for $2.4 billion. But Dick's down almost 15%. But love a good M&A story. For that story, we're going to bring in Bloomberg's deals reporter Fareed Sahloul. Now, I was taking a look at the one-year chart of Footlocker to see, you know, how expensive is this deal really? And that $24 a share is actually $2 above the one-year average. So it's not just a more than 80% premium. It's actually more expensive than the average trade all year.
Yeah, so, well, look, shoe M&A is pretty hot right now, right? We had Skechers last week.
True.
$9 billion deal. We've now got $2.4 billion being paid by Dick's for Footlocker. At first blush, this looks like it might be a tariff-related play, right? Both companies sell brands like Nike and Adidas. They have big manufacturing hubs in China and Vietnam, and so anything that can help them weather that storm is great. But of course, the truth is the American consumer was spending less even before Liberation Day, and both companies have been looking for ways to kind of boost sales. You know, this deal will give Dick's Sporting Goods more presence in the malls over here in America and a bigger international presence. So, you know, apologies for the pun, but if the shoe fits,
yes.
And it does fit, so, yeah.
Oh, yeah, that's pretty good. That's pretty good. I like that pun.
I'll take it.
We were actually looking for other shoe sellers on our morning meeting, right? The finish line already got taken out. You mentioned Skechers was taken private.
Yeah.
I'm not sure about designer shoe wear, if DSW is a target.
Well, I'm not sure about that. I mean, most sectors at the moment, retail included, we're watching for signs for any kind of rebound in M&A, right? The market has dried up this year, despite what bankers will tell you about there always being the right conditions for M&A is available for the right deal. But it's been pretty lackluster. We have seen some signs of encouragement recently. This deal included last week, as I mentioned, Skechers. We had Sunoco Parkland. So, you know, I think whether it's in retail, whether it's in energy, whatever, people will be looking for a continuation of that.
You know, it's interesting. In addition to M&A, while we have you, the IPO market has been a pretty interesting thing to watch lately. I'm wondering, you see the Dick's reaction, a brutal sell-off on the heels of this deal.
No pun intended.
Oh, God. Okay, I didn't even do that on purpose. But, you know, do you see more likelihood for IPOs if investors are not necessarily rewarding buyers to go out and spend a few $billion right now?
Yeah, so, you know, this is the other the big half of the deal-making market, right? What's happening in equities. Like M&A, it ground to a halt after Liberation Day. Lots of deals were pulled. One of them was eToro, for example, the trading platform. That's come back. MNTN, the TV ad company, that's come back. as well this week. And
we have to always say Ryan Reynolds.
Reynolds, exactly. Yeah, he's always the kind of the first thing that comes to your mind when you think of.
He actually did. Did you see his little commercial for the Mountain IPO?
I didn't know. Most of my kind of Ryan Reynolds exposure is through Wrexham Football Club, which is, I'm a big football fan, so that's where
Fair enough. Well, I noticed on Twitter this morning that he's made like an ad for Mountain shares. So he says like, oh, we saw this business, knew we had to get involved. Now you have a chance, right?
Okay, well.
Shilling the shares.
Well, that's a new way to roadshow.
Right?
Yeah. Yeah.
Well, you know, he's doing it with MNTN as well, and we've got a couple of other stocks now that we're going to be keeping an eye on now that the IPO market looks like it's reopening. Klarna being one, StubHub, Medline. So, you know, after what was a pretty catastrophic April for deal makers across M&A and IPOs, we're looking a little healthier going into the spring, and they'll be trying to get deals done before the summer.
Yeah, that's the reality, Matt. You look at eToro, CoreWeave's, tough day today, but generally really good after the IPO. Deal makers inside of, let's say, Blackstone, where you're looking at a massive asset like Medline, are very excited to look at these trades.
Yeah, it's great to see an exit for those businesses, right? And at the same time, they have some entries as well with the increase in bankruptcies or restructures. Fareed, thanks so much for joining us. Fareed Sahloul from our deals team talking about the M&A we've seen today. Coming up, an exclusive interview with the CEO of JPMorgan, Jamie Dimon, says a recession is not off the table. This is Bloomberg Open Interest.
Now, Jamie Dimon says we are not out of the volatility woods yet. The JPMorgan CEO spoke to Bloomberg's Francine Lacqua earlier today in a Bloomberg exclusive. Take a listen.
We have all this uncertainty. Some preceded the new administration, like we had large deficits, interest rates going up, inflation going up, and some are, tariffs and things. And of course, the geopolitical situation is very tense, very difficult, and hard to resolve.
Okay, so if you forget projections, numbers, what's your hunch? Is the U.S. going to go into recession or not?
Look, I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
If you look at, the trade war and then the somewhat reconciliation between the U.S. and China, does it hold?
I think it's the right thing to do is to back off of some of that stuff, to have an engage in conversation. I'm grateful they did the U.S.-UK deal. It's an agreement in principle, so, there's a lot of uncertainty still, and there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets. That's not the reason to do it, but the markets, do vote and something like that, and so you'll still have uncertainty to resolve. There's 90-day triggers in a lot of these things, and hopefully they will be resolved. But they're complex. I don't expect immediate resolution, to the satisfaction of everybody in 90 days.
But do you expect markets to settle from here because we have a little bit more of a blueprint, or could volatility pick back up at any second?
Markets are quite unpredictable. I think there's a lot of uncertainty out there that you can't discount. War in Ukraine, terrorism in the Middle East, Iran. Huge deficits, our tax bill, which I would like to see a good tax bill pass. The tariffs, the reaction of countries to tariffs. The EU and the UK are about to negotiate, and I think they have a chance to actually develop a great relationship, partially making up for, the disaster that Brexit became. And so, yeah, those are uncertainties. You can't eliminate them because you want to.
But what are your biggest clients saying about this market volatility? Have they made money on the back of it?
Yeah, some do and some don't, and volatility could be good or bad depending on who's facing it. So, but I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and the volatility itself will calm down.
Has it been good for JPMorgan? What's your trading revenue looking like?
Yes, because when there's volatility, this is a very simplistic way to look at it. Spreads gap out and traders make more money if there's more volume. So we had both this time, more volatility, more volume. But very often when you have a lot of volatility and spreads gap out, there's much less volume. So you've seen examples where there's good volatility and there's bad volatility. This one happened to be good. The next go around may not be so good.
Jamie, when it comes to financials, I mean, a lot of, I guess, non-bank entrants are making quite a lot of way. Citadel, Jane Street. Is that a concern for the banks? Should it be a problem for the banks?
I wouldn't call it a problem. They're both clients and very capable. But I've always had the view there are a lot of competitors out there, and all the major banks are back. I think that's a good thing for the world. Maybe not so much for JPMorgan. You mentioned those two. There's Apollo. There's a lot of fintechs, some very good ones. There's Stripe. There's PayPal. Yeah, my view has always been the same. I tell the management team, assume competition. Assume they're coming at you in every angle. Assume they often have their own strengths, sometimes their own weaknesses. They won't all do great, but yeah, I think they're, some of these people are gaining quite a bit of share in parts of their business. We still are too, by the way. So, we're in the fight. We're not losing out very much, but that doesn't mean you won't lose out tomorrow because you're winning today.
That is JPMorgan CEO Jamie Dimon speaking in Paris with Francine Lacqua earlier today. This is Bloomberg.
Maybe 40-80 will be an ultimate proposal. So far, unfortunately, the Ways and Means Committee has not offered us anything anywhere close to that. Sadly, they've been stubborn and not give us anything that we could possibly say yes to. We got to go back home and sell this. And a low 30K cap, when unlimited would come at the end of the year if this bill expires, wouldn't be sufficient for my constituents.
Republican Representative Nick LaLota there from New York speaking on balance of power yesterday, discussing the possibility of accepting a cap on the state and local tax deduction when doing nothing would mean there's no cap at all. Obviously, for people from New York, that doesn't make very much sense. Let's get to Kailey Leinz now. She anchors Balance of Power. So, Kailey, what do we know now about the potential for a SALT deduction? Even raising it to 80 wouldn't matter that much if you still have a very low income level for people who can access it.
Well, that's exactly the question, Matt. Obviously, there is an ongoing discussion about the level of the SALT cap itself, which SALT caucus members from New York and states like California are advocating should be higher than $30,000. But even if they can get that number itself higher, there's a question of what they have to give in return, which could potentially mean a lower level of the income threshold for those who can actually claim this deduction. It also could mean that this is only extended for a certain period of years rather than it being something permanent. Those are the kind of concessions they might have to make here. We do expect we will learn a lot more when SALT caucus members emerge from a meeting that is underway right now with the Speaker of the House, Mike Johnson, though I would note it's not just SALT members who are in that meeting, but other conservative fiscal hardliners in the House, Freedom Caucus, for example, who want to see the overall cost of this package much lower and more spending cuts. They are not advocating for a higher deduction, really, for anyone in these blue states. So we'll see what emerges from that. I would point out as well that the House Ways and Means Chair, Jason Smith, spoke with David Rubenstein at the Economic Club of Washington earlier, and he maintains that $30,000 is a generous level, and he thinks it should stay there.
Kailey, we have about a minute left here, but I do want to ask you about a Bloomberg scoop that had crossed the wire less than an hour ago, I believe. We have people within the administration looking at Trump's trip to the Middle East and the deals being cut among the AI industry here, causing concerns among China hawks in the administration. How is this playing out?
Well, there's kind of two concerns here, Sonali. One being the sale of NVIDIA or AMD chips to countries like Saudi Arabia and the UAE in and of itself could present a national security risk, because this is an area where the U.S. wants to be dominant in for its own national and economic security purposes. So there's that element of it. But the bigger, perhaps, for China hawks especially, is the concern that there needs to be clear legal guardrails to make sure that any chips sold to Middle Eastern countries don't end up in China ultimately, because, of course, the U.S. has taken great effort to make sure that a lot of these chips cannot be exported to China so that China can develop its own advanced technology capacities. So the broad outlines of this deal don't necessarily have the specific guardrail language in it, and that is what a lot of these more hawkish members of both the administration and Congress that look at this are looking for here. They want to see essentially a tightening up of the rules to make sure it doesn't get into hands they don't want it to be.
All right, Kailey, thanks very much. Kailey Leinz there, co-host of Balance of Power. We will tune in when you go live at 1 o'clock on Bloomberg Television. From Sonali Basak, I'm Matt Miller. This is Bloomberg.